Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you. Today is December 15th, 2009, and my guest is James Hamilton of the University of California at San Diego. He blogs at Econ Browser. James, welcome to EconTalk.
Glad to be with you, Russ.
Our starting topic for today is the federal government's budget deficit and what that deficit might mean, if anything, for the future. In a recent post at Econ Browser, you reacted to Paul Krugman's claim the deficit wasn't really worrisome, but you seem to be a little worried about it. What are your concerns?
Well, first, I'd like to clarify that I'm in complete agreement with Paul that we don't need to balance the budget right away. A large deficit in 2009 and 2010 is quite desirable and necessary. And I think if we tried to balance the budget right now, it would be counterproductive to the point of being infeasible. So where I have my concerns is with what's going to happen a couple years down the road. What's the longer-term trajectory? And Paul's position is that we can grow our way out of whatever we dig ourselves into. Just as at the end of World War II, we had a debt-to-GDP ratio in the U.S. that got above 100%. We worked our way down from that with economic growth. And Paul also points out there are a number of other countries in the world that have those kind of debt levels and have worked out of them through economic growth.
I think it's important to just for listeners who aren't used to thinking about debt, when you talk about the debt to GDP ratio, debt is a stock, I think, and GDP is a flow. That is, one is at a point in time and one is describing something that occurs over time. So if you think about if you make $50,000 a year in income, that's an amount per year, and you owe $50,000, which is a stock, just a number without a time component, that would be 100%, right? That's what it means. Because I think some people might think, well, 100%, well, then you're bankrupt, but you're going to repay it over time, and if you grow, your ability to finance that, both the capital and the principal and the interest, is feasible.
Well, that's right. They're in different units. But, of course, the key question about the debt is the service cost, which is a flow, an annual flow. What do you owe in interest on that per year? And with a given interest rate, you're basically talking about the same comparison. So you take the $50,000 debt and say with 5% interest, that's $2,500 per year. So
that's manageable.
That's still something you'd want to compare with your $50,000 income. So the ratio of debt to GDP, although you're right, they're in different units, is a very natural kind of way to think about the overall burden. And certainly referring to the historical norms, I think, is quite relevant in terms of if it gets far out of line with the kind of thing we've seen before in peacetime, you wonder what is going to stabilize this.
So are we out of line in peacetime?
Well, yeah, there isn't anything apart from World War II that's like what we're getting into right now. So this is a pretty unusual development. We're talking about deficits this year and next on the order of 10% of GDP. So that's a pretty big deal.
If we have time at the end, I want to come back to the question of whether the current level of deficit is desirable or infeasible to do something about, whether it's infeasible to do something about it. But I want to stick for now with just the mechanics. So I think this past week the Senate voted to lift the debt ceiling from $12.1 trillion to something closer to 14. Is that correct?
I don't know the exact numbers.
It's something like that.
I'd emphasize that there is a political game that goes on that's very separate from the economics. Politically, we have separate votes in the United States on the spending and tax questions,
right,
which determine the deficit, and on the total allowable ceiling for the debt. And from an economic perspective, it's very strange to separate those two questions because
isn't it? Yeah.
there's no way you can run a bigger deficit without increasing the debt. It ends up being something where the politicians can say, well, I voted against the debt increase, I'm trying to do something about this, but yet when it comes to taxes or spending, they were the ones who voted to create the basic need to do the extra borrowing.
Yeah,
so
it's an excellent point.
I'm a little concerned about the grandstanding some politicians like to carry on when we get to the point of voting on the debt ceiling. To me, the real question is taxes and spending.
But I brought it up because I think, first of all, 14 trillion is a really big number, and that alarms people. And that is close to our GDP, probably a little bit above it right now, if I have the number right. It's in the 13s. And I think if you apply the discussion we had earlier, it's a little harder to do because there isn't a single interest rate. So a lot of the debt that has been issued in the past, it's all been issued at different interest rates. And then there's a current rate that the Treasury has to offer to attract additional funds. And that right now is very low, correct?
That's right. It's practically free if you're looking at the very short-term debt.
It's close to zero. So right now, we expect to borrow something on the order of $1.5 trillion to finance the shortfall next year, in the coming year, to finance the shortfall of revenues relative to expenditures. But in addition, we have debt coming due because of the way the past debt was financed, correct? So we have borrowing we're going to have to do to pay off old debt, and we've got interest rate, mostly on old debt, interest rate, the service cost, as you mentioned, right?
Right. So to a first approximation, the change in the debt is equal to the deficit because you basically have to roll over that outstanding debt. You haven't done anything to pay it down, plus you've added new debt in the form of this year's deficit. Now, there's another complication we could get into as to who is holding the debt. A lot of that $1.5 trillion number you're talking about is not actually owed to the public. It's owed by one branch of the government to another branch of the government. And so often we net those out to talk about the net debt to the public, which is a little bit more modest number than the one you're bringing up here.
That's a good, excellent point. How modest a number is that roughly? Do you have an idea?
Well, we're talking about something that at the end of next year would be 60% of GDP instead of the 100%. So it's really a sizable sum. The Federal Reserve owns a significant chunk of the federal debt at the moment, and the Social Security Trust Fund is by far the biggest single holder. So that's basically money that the government promises to pay to another entity of the government.
So does this include, this may clear up a puzzle I have trouble thinking about clearly. The Fed is currently buying mortgages that are being held by Fannie and Freddie. I think they've got about $1 trillion on their books. And somebody told me, well, that's nothing to worry about because they're guaranteed. Well, yeah, they're guaranteed by the government. So what is exactly going on there? And do you have any idea how that enters into the accounting at all, if at all?
Okay, well, the mortgage-backed securities the Fed is buying are not so much owned outright by Fannie and Freddie as guaranteed by Fannie and Freddie.
That's right.
And so, yes, the government is on the line for those,
because of the conservatorship that Fannie and Freddie are operating under. Their obligations have been assumed by the government explicitly. It was only implicit before, right?
Right.
Now it's explicit.
That's right. So there is, potential liabilities on all kinds of fronts. You can talk about the potential liabilities from Fannie and Freddie, and while we're at it, let's throw in Ginnie Mae and the FHA and the FDIC. These are huge numbers. The future healthcare costs are a real monster when you project the trends for those. And the Social Security Trust Fund, I mentioned it's money that the government owes to itself, but the accounting notion was that was a payment the government was going to have to make in the future to the future retirees. So you start looking at these kind of questions. They aren't part of that direct debt calculation. They're not part of the accounting identity we talked about relating the deficit to the debt, but they are part of what constitutes the potential solvency of the federal government. And that's where I was raising the issue about where's this all headed in the future, and I think there would be reasons to be concerned about that.
But it's not, as you, I think, very wisely point out, it does not necessarily generate a requirement to issue treasuries to borrow that money in the coming year.
No, it has no such requirement, and of course that's what the real seductive aspect of these loan guarantees was. It's totally off budget. Looks like you get something for nothing, and that's what Fannie and Freddie were doing, collecting fees, relatively small fees over the years for promising that they would make good on all these loans they were securitizing, and Fannie and Freddie had nowhere near the capital to do it. Implicitly, it was the government, and now explicitly, but the government still likes that game, and not just Fannie and Freddie, as I said, but also the FHA and Ginnie Mae, and we're still in that same business of making promises that are off balance sheet, but may come back to bite us on the real cash flow side in the future.
Well, I'm a little still confused. It's a very complex topic. We have, according to the legislation, there are certain promises to retirees on the books right now, as there is also medical care promises in the form of Medicare, barring changes in the current law. But under the current law, we have a lot of promises to a bunch of people who are getting older and sicker as time passes, and I assume some of those promises will just not be kept. And I think most people assume that. Of course, that may turn out to be false, but if the U.S. breaks those promises, changes the letter of the law of Social Security, say, and puts, for example, a later retirement age or an income means test, there are many ways at which it could deal with the fact that it might not have as much money as it would hope to have down the road to pay those promises. That seems to be different than paying back the bondholders of last year, or the Treasury securities holders of last year, or the people who say those FHA mortgages. Aren't those a little bit different?
I think they're totally different.
Okay.
I don't think the U.S. has a legal obligation to be having exactly the same retirement age and exactly the same health benefits that get covered 20 years from now as they're doing today. And indeed, I think it's not really going to be feasible. As I say, you project these trends, and there's nothing but trouble ahead. On the other hand, if the federal government were to default on its obligations to bondholders, that has very dramatic repercussions in terms of our ability to borrow next time, and we still need to do a lot of borrowing, and the whole world financial system. So they're totally different issues in my mind, even though you might say there's some sense in which the government is reneging on something in both instances.
No, I agree with you. That's why I brought it up, because I think they're totally different. And so when people talk about the looming demographic train wreck, to me it's of a different nature than the risks that we're under between, say, 2010 and 2013 as we spend, say, 1.5 or 1 something trillion more than we take in each year.
That's right. That's why I was pointing to that as a longer run issue rather than what's happening just right this year.
Okay, so let's turn to the current. Let's talk about what we might call the short and medium term. Short being 2-3 months from now, 1 month from now. Medium being the 2010 to 2013 period. The longer, but not too long. Not dealing with these demographic issues that are going to cause adjustments of some kind or another. So here's my worry, and tell me if you think this is not a worry. I just read, there was an article in the Washington Post this a week or so ago, and it was detailing the nuts and bolts of a $31 billion sale of treasuries to raise $31 billion more dollars to cover the government's expenditures. I was trying to find the article, by the way, and I Googled $31 billion debt, or $31 billion deficit, Washington Post, something like that. And I happened to also pull up Freddie Mac will ask for $31 billion from taxpayers, and GM lost nearly $31 billion in 2008. 2 other government problems that are being dealt with. So we've got a lot of uncertainty. What struck me as frightening, potentially, about that article was the $31 billion was a 4-week loan, a 4-week treasury. So it basically said, give us $31 billion for 4 weeks, and in 4 weeks, we'll give it back. I think the interest rate on it was very, maybe zero, literally zero. It was basically, we'll park your money, and if there's deflation, you'll be covered. Of course, if there's inflation in 4 weeks, you'll lose a little bit. But it basically said, we're going to borrow this under a very, very short-term period because it's cheap to borrow short-term. People aren't really too worried about default 4 weeks from now. Most people aren't worried about any kind of default, but certainly the U.S. is not going to default within 4 weeks. So you don't have to offer a very high interest rate. And when I read that, I thought, gee, that's what the investment banks did that went broke. They borrowed under very short-term rates under very short terms because they could get a very low rate of. They only had to pay a very low rate of interest. And when people start worrying about that, people could suddenly stop, and you can't finance the next $31 billion. Are you worried about that at all? That short-term aspect of it?
Well,
it's not 30 years.
Over the 2-month horizon, because I think that 2-month rate is sending a signal that you summarize that we're not going to have that problem by January 2010. And you can look at the yield curve. It does slope up, but fairly gradually, and the government can borrow very cheaply for several years, and even the long-term rates surprise me with how low they are. And that, again, is one of the arguments that Paul Krugman makes, that look, those rates at which the government can borrow at various horizons are still very low. It doesn't look like markets are worried about that, and I think that's an accurate summary. Markets are not worried at the moment.
Today, yeah.
The question is, could things change that would cause people to be more concerned at some point in the future? And I agree with you, things could. And what's the nature of that scenario? Well, the thing that's going to help all of this mathematics is economic growth. And so if we continue to see growth of the U.S. economy like we did in the third quarter, that's going to help a lot for all of these things, not just bringing in more tax revenue, but reducing the risk of the government having to pay out more on these implicit guarantees and greater stability to the financial system. And so if things play out that way, I think that you'd see interest rates rise as they do normally in an expansion, but it would all be kind of healthy and manageable. Where things would create a problem is if something comes up that really causes people to question the ability of the system to keep going. And there are things that could happen along those lines. If we had another recurrence of serious financial problems, we still have the other shoe in the form of commercial real estate, for example. If the economy were to sputter from here, or if the politics were to play out in a way that people become much more concerned about just how these longer-run issues of medical costs and so on are going to be resolved, then I could agree with you. There could be a day coming when those short-term rates would change very quickly and the expectations would take a different course. I guess, I don't think it's going to happen in 2 months, but I could imagine it happening in 2 years or some kind of medium-term horizon. And I think the key policy for addressing that is for the U.S. to take a more responsible stand on these longer-run issues. Let's demonstrate that we really do have a path that's going to make sense going into the future and that people can believe. And I think that's what's necessary to prevent the kind of crisis you're talking about, rolling over near-term debt.
Yeah, I just want to clarify that 2010 is about 2 weeks from now. It sounds very far away, 2010. So I actually say 2010. That sounds like next year to me. But when you say 2010, that's like That's like Buck Rogers. That's like so far away, but it's not. It's a little over 2 weeks away from when we're taping this. And
well, yeah, okay, but so,
I knew what you meant. I'm just making a joke.
The 2 month.
Well, let me paint a negative. Let me paint a negative scenario for the 2 month thing that I am a little worried about. Maybe I'm being paranoid, and I have to confess, I was a deficit dove in the past. I would always say that Milton Friedman's insight, which I think is still basically true, and most of the time true, which is it's not so much how you finance government spending, whether it's taxes today or taxes tomorrow. What's important is what you spend it on. It's true that if you finance it with taxes tomorrow, which is what debt is, you're going to pay a little higher price for it. So you want to make sure that what you're spending on is particularly good because it's a little more, there's an interest cost. But in general, there wasn't any imminent or even vague risk of default. It was just perhaps a little of a luxury to run a deficit in the 80s and 90s. What I'm worried about, and maybe again I'm just being paranoid here, is we're supposed to borrow about, I'm told, and maybe I'm wrong, maybe it's wrong, about $3 trillion in the coming year. It is possible that a combination of that magnitude and other signs of economic challenge, like you mentioned, and so the one that's on my mind, besides commercial real estate, is another wave of foreclosures and mortgage defaults. Mm-hmm. I know that Fannie and Freddie purchased about 600,000 mortgages in 2007 with less than 5% down. Those mortgages are probably not doing very well. Something between 25 and 33% of U.S. mortgages today are underwater. Some of those are going to reset in 2010. The interest rates, they were adjustable rate mortgages, and I assume that's not going to look so good, barring some surprising appreciation I don't anticipate. So that combination, given plus the magnitude of the amount of borrowing we might have to do, could be difficult to actually pull off. It's conceivable that the Chinese or others might say, this doesn't look as safe as it used to, and it would, I assume, start with a rising interest rate. That would be the signal. So my first question is there a doomsday scenario like that you can imagine in the short run, within a month or two? And also, what would be the warning signs that might be imminent?
Well, let's start with some numbers. So the current baseline projection from the CBO is for a total deficit for 2010 of under 1.4 trillion, and then for 2011 it's under 1 trillion. So those are the kind of numbers we're looking at.
And what growth rate are they assuming for the economy as a whole? Are they assuming a continuing GDP recovery? I assume they are.
Yeah, I don't have their number here for that.
That's okay.
That was the point I was making, that economic growth helps everything in terms of revenues, and is one partial salve for the doomsday scenario you were painting there. I think unemployment is one of the key factors in defaults and all the rest. So, yeah, that is definitely a possibility, and markets don't seem to be expecting it at the moment, given the very low rates. But if something were to happen to really change expectations, it might become a concern. I don't think we can rule it out 100%. I think it's not the most likely scenario from here. But I think it's sufficiently likely that my position is we ought to be implementing longer-term structural moves that makes the U.S. borrowing at the moment credible. I think those low rates are, practically zero rates at the moment, are a reflection of the historical fact that the U.S. has been relatively responsible with our debt management. And when you are responsible with your debt management, you can borrow at times like this very favorably. And I think as long as there was some long-term assurance, that helps mitigate the risk of the short-term crisis.
This is the tallest pygmy theory, right? So that the U.S. is struggling, but compared to other nations, we're still a relatively safe place to park money, and so we are the parking lot of choice.
Well, one of the very interesting things in the fall of 2008 was this flight into dollars. And it was kind of surprising because the U.S. was ground zero for the world's financial problems, and yet people wanted to park their money in dollars. And even now, despite these concerns about U.S. fiscal solvency, as we're saying, those short-term borrowing rates are practically zero. So I think there is a link between the short run and the long run, and that link has to do with credibility. And we shouldn't take it for granted that we're always going to have that credibility as a nation, that we're always going to be able to do this. It's the kind of power that it's possible to abuse to the point that you lose it, and that would be a very frightening thing. So I think I'm agreeing with you. This is something to pay attention to. I see it as something for really focusing on what we're doing as we pull out of the current situation. Now, we could get into the other details of where the specifics of where the recovery money got spent sensible, and I think we both share some criticisms of those. That's totally valid, and that's something too that you could argue undermines the ability of the U.S. to weather a crisis like the kind you're describing if it were to come out that way.
Although I think to the credit of the administration, they've not proposed a second stimulus package of the same kind. So for whatever reason, and I think, of course, politics plays a key role, but they've not said, well, we just need more of the same. They've talked about different kinds of spending, particular tax cuts to businesses as a way to improve the employment picture. So I think we'd be in a different situation if the administration responded to the current double digits of unemployment and said, well, we need another $787 billion. I think that might have been it would have been an interesting experiment, but we're not going to see it. Let me ask you about two things that are related to these issues. What is the possibility that the debt will simply be monetized, that the Fed will print money? A lot of people say, well, we'll never default because we'll just print money, and the Fed can always do that. So there really never is a real risk of default. What's your reaction to that?
Well, it's true by definition that what the government owes is dollars, and the government could create as many dollars as it needs to fulfill those obligations. So with a default, we're not really talking about failing to do that. The question is, can you do that without a very dramatic deterioration in what a dollar can purchase? And in particular, the doomsday scenario we were discussing, in my mind, is very much joined with a currency crisis, a sudden collapse in the value of the dollar. And that puts the Federal Reserve in a very tough situation. So they can defend the dollar by raising interest rates and letting the Treasury default, or they can try to step into the gap. I think people within the Federal Reserve would be sort of horrified at the presumption that they're going to play the role of bailing out the government in this situation and monetizing the debt. But the way that I would see it playing out is frankly similar to what happened in the fall of 2008, where there was this real crisis developing and could have had very significant consequences, and the Fed just decided, well, somebody's got to solve this problem near term, and we'll sort out what this all means later, but we'll just step in with creating reserves to whatever level we need, and in short order, they basically doubled the Fed's balance sheet. Did that as thinking of it as kind of a short-run response to the crisis rather than a long-run strategy of, well, we're monetizing all of this. And I think that's how it might play out in the scenario you're talking about. I think the Fed would be very reluctant to knowingly go down that road, but I could see them taking a series of emergency measures to get past this week's auction or that week's development, which has a similar kind of effect. But it's a standard problem with these currency crises that it puts a country in a very unfortunate situation, and there isn't a good option. You're talking about real threats to the real side of economic activity, along with what's going on with inflation and the value of the currency. It's a very unfortunate thing to have happen to you, and that's why you want to make sure you're running your ship in a way that you don't get there in the first place.
Yeah, pardon my snort there. I just it would be a very unfortunate thing, I think. And I want to get to the the snort wasn't at your analysis. It was that we find ourselves in that situation, or that we're close to it, is rather remarkable. I want to turn to the real impacts of a possible, if there were such a default or an inflationary semi-default, whatever you want to call it. Before I do, I just want to make one more clarifying point about the worst-case scenario and get your reaction. In other sovereign defaults where a nation no longer can honor its promises, my impression is that the signals come very late and very suddenly, that there isn't a long looming warning that things are going bad. It's that things look great, and then all of a sudden it's over. Is that an accurate summary of the experience of the last couple decades of sovereign defaults?
Well, we're talking, I think, not just about sovereign defaults, but also about currency crises. And as I was saying, I think the latter is kind of the key model for the U.S. because we do have the fortunate position of being able to borrow in dollars and the capacity to create those. So I don't think you need to go all the way to default here, and I don't think we would. But there've been a variety of experiences, in either category over time, and I think it's a mistake to lump them all together and say they all follow this pattern. Often it is the case that you have a country that was seeing real growth and acquiring a lot of debt as a result, and things looked very good before they looked bad. I think this run up in the public debt is an element you'd find in many of the other episodes, and if you took the name U.S. off of the current numbers and replaced them with some small developing country, you'd certainly say, yeah, this is the kind of situation that could go that route. So, on the other hand, I think you would see some movement in short-term interest rates in advance. It's really remarkable how extremely low the short-term borrowing costs for the U.S. are, and I don't think you'd find an analogous situation in the other experiences of a country that went from that kind of borrowing advantage to suddenly the sort of crisis we're talking about within a space of months.
I'm fascinated by your observation, which I think is undoubtedly true, that if a different country's name were on these securities, that we'd be in a different situation. Why is that? Is it just that it's, quote, unimaginable? Is it the past goodwill we've earned? Is it a trust or an expectation that that ship you're talking about will find its way to a safe harbor? What do you think?
Well, it's a combination of those, and on top of all that, I would put the sheer size of the U.S. I mean, we're so important as a consumer and producer in world markets as well as financial sector that this would, if it did happen, it would be an effect not just on us but on the whole world. We were talking about there was this initial flight to the dollar, and if you don't trust the United States, who else don't you trust? There's going to be a lot of other victims of this if it were to unfold the way you were describing. So there a lot of these factors: the sheer size, the tradition, and as I was pointing out, the history of responsible management of the debt, and that's why I want to emphasize let's make sure we're doing that last step correctly now.
Let's talk about the Chinese for a minute. They've made some angry or worried noises about the possibility of inflation that would reduce potentially dramatically the value of the money of the resources we return to them for the promises they've made, the money they've given us. What do you think they're thinking? I know there's no there. When I say they are thinking, there's no they. It's obviously a more complicated situation. But what strategy are the Chinese doing? What possible explanations are there for what the Chinese are doing and continue to do by putting relatively large sums of money into U.S. treasuries?
Well, they're keeping the yuan from appreciating, and they're thereby maintaining an export market. Now, most of our economic theories say that wouldn't be a way to enrich a country. It has worked fairly well for them so far. Another thing that I see them having done, though, in addition to accumulating these huge dollar holdings that leave them vulnerable to the kinds of events we're talking about, they're also accumulating huge holdings of physical commodities, gold and copper and oil and basically anything you can store, they've been storing. And so although it's true that they're going to take a serious loss on their dollar holdings if these events we were discussing were to take place, they're going to also take a good gain on their commodity holdings. So I'm not sure that they're as totally exposed as just looking at the financial numbers might lead you to expect. But as far as the logic behind that whole export-based economy goes, I'm not the one who can really explain it to you, what they're thinking.
Neither am I, so that's okay. It's a mystery to, I think, a lot of people. I don't know whether they have a different theory or they are playing a different game than we think. Let me close this section. Anything else keep you up at night? You talked about the looming demographic issues with Social Security, Medicare. Any other, and commercial real estate lending that might come crashing down? Are there any other economic forces that you're alarmed about in the short run or medium run?
Well, I guess one of the things we didn't mention in all of this is if you look at federal tax receipts as a percentage of GDP, that's historically in the U.S. always been below about 21%. Yep.
And very flat.
It's a remarkable long-term stability, and if you look at these trends for medical expenditures in particular, it's just growing much faster than GDP. So something's got to give here, and I'm not sure how it will give. We've been talking about one way it could give is that. The world suddenly figures out it's not good to lend to the United States anymore. Another way it could give would be, a big increase in the percentage of taxes that the federal government collects, and I would think that would potentially be something that would sacrifice our long-run growth potential. And moreover, just the whole experience of the last decade, where we haven't created jobs, we've invested in housing rather than productive capacity, and at the government level, not investing in infrastructure, but basically increasing transfer payments. And I worry about the longer run trajectory for the United States. Are we really trying to make the world a better place in 20 years, or are we just passing all these problems on to the next generation? So that's a theme that shows up a lot of places that I find troubling, I guess.
Well, it's always anytime I can now, I quote Lloyd Blankfein, the CEO of Goldman Sachs, who said, as a paraphrase, that Goldman Sachs and other investment banks were doing God's work because they were channeling capital to its highest valued use. And so between 2004 and 2006, we channeled about $1.5 trillion into subprime mortgages, people buying homes they couldn't afford typically, second homes, third homes, bigger homes. I don't think that was its highest valued use. So unless we can, as you point out, I think we'd be more productive if we channeled it elsewhere, but the incentives were such, as we've talked about many times on this program, that it went there. And that, if that doesn't change, it's not a good sign for long-run prosperity. So I worry about that. Well, let's shift gears and let's talk about an area that you have done a lot of very careful and interesting work on, which is oil prices. There's been, in the past decade, a long run-up in oil prices that I think is easy to miss. The prices at the pump bounce around a lot, but I was struck in your work of that trend. I wasn't really aware of how long and sustained it was. And people have debated about why that is. Why has the price of oil risen steadily for the time period it has? And I'd like you to talk about what you think the answer to that question is, and then I want to turn to what you think the impact of that is.
Well, let's focus on the last legs of it, say from 2005 to 2008, where you saw a real acceleration of that trend, which, as you observe, really goes back to 97. The price had been coming up since then. Between 2005 and 2008, world production of petroleum basically stagnated. We weren't producing any more globally 2.5 years later than we'd been in 2005. And yet in 2006 and 2007, world GDP increased by more than 10% in real terms. And that's something that would produce a tremendous increase in demand for oil, along with all kinds of other items. And indeed it did. So China, for example, increased its consumption of oil by something like 1 million barrels a day over that period, just those 2 years. Now, how can China be consuming another 1 million barrels a day when the world as a whole isn't producing any more oil? Well, the only way that can happen is for people in places like the U.S. and Europe and Japan to consume less oil than they were, despite the fact that our economies were growing. And
well, we could have drawn down inventories, though, right?
Well, why would you draw down inventories? This isn't a temporary development.
Well, I don't know. I'm just trying to, when you just talk about it as a... let's talk about the facts. As a
matter of accounting, it could come out of inventory.
But the facts are: did we consume less oil over that period? The U.S. and Japan. Okay, yes. So that's all that's relevant. Go ahead.
Yeah.
Sorry.
So in fact, the consumption of the OECD countries was down about 1 million barrels a day to make up for what China was adding.
And that was
that's the way the numbers work out. But it takes a very big increase in the price of oil for people to change consumption. It's highly price inelastic over the short run. And I think maybe more so in 2005 and 2006 than it had been historically, partly because the energy expenditures had become modest enough for a lot of Americans that we could just afford to ignore those initial price increases. So I think that's not just the mechanical explanation what went on those years, but it's the broader picture that's changing as well, which is there's been a really remarkable thing that's happened globally, with China being the most dramatic example, but a lot of the newly industrialized countries, it's been a major change in the standard of living within just a generation for a whole lot of people in the world. And those people now want cars and all the rest of the stuff which takes oil. And that's come at the same time that the world has been challenged in terms of the ability to increase production further. Now, we could talk about that second side of the equation, and it's a complicated story, and I think you're going to have different details, different places.
Sure.
But the bottom line is that it's not all that easy to keep on increasing oil production year after year, and in particular, it's an incredible challenge to try to keep up with the growing demand from the newly industrialized countries. So I think this is something that's also going to be the trend for the next decade. Now, short run, you have other issues. Obviously the world recession took a pretty big bite out of world petroleum demand, and there have been some longer run adjustments to those price increases in the U.S. and elsewhere. But there's still a lot of people in China, and the vast majority of them don't have a car yet.
Yeah.
And if their incomes keep growing, more and more of them are going to want cars. And so I see this as a significant long-range challenge.
Let me ask you about Saudi Arabia, which you refer to in your paper on this. That you've written more than one, but the one I saw, which we'll put a link up to on the web. So you're thinking about this the way I usually think about it, which is a supply and demand picture. You've got a relatively vertical supply curve in the short run. You have an inelastic demand curve shifting out, and that's going to mainly be reflected in higher prices. And nations are going to respond differently depending on the flexibility of their economies. Individuals will respond differently depending on their flexibility. There'll be short and long-run differences, of course, more flexibility in the long run. But it's not quite a clean supply and demand picture because there is one supplier, there may be more than one, but certainly one, who kind of does have a massive inventory because their extraction costs are so low relative to the rest of the world, and that's Saudi Arabia. Is that still the right way to think about what complicates this picture, or is that not right?
Well, for years, the Saudis were the world's swing producer in oil markets. They had a lot of excess capacity, and they would change their production volumes on a monthly basis in response to market conditions. They would increase production when prices were high and lower production when prices were low. And they claim to have huge reserves, and they claim to have lots of excess capacity. So a lot of people were just assuming that the Saudis would always play that role in that way. So just a couple of years ago,
which smooths the price, right? So you would think that as prices running up over this decade, they would find it lucrative to respond with much bigger production, tempered by their desire not to lower their revenue elsewhere and the other previous units, but that they would smooth that cycle a little bit. But they're not doing that now?
Well, they did that up through about 2005, and then their production stagnated and started to decline. So that was, in terms of the accounting, people who were looking at these trends and projecting out, okay, China's going to be consuming more and so on, where's it going to come from? The assumption was it was going to come from Saudi Arabia, and the facts were that it didn't. Now, what explains those facts is a more complicated issue. Do the Saudis have as much oil and as much capacity as they're claiming? That's an open question in my mind. It may be that they perceived it wasn't in their interest to stabilize the price at a lower level, or it may be they found that they couldn't really. Right. They didn't have that capacity. But even if they do have that capacity, and you think they could go to 15 million barrels a day, or the kinds of things people were assuming for them, which they have never said actually that that's what they're going to do. But even if you thought they could, it doesn't take too many years of growth of China for that to get eaten up, and then you're still back where we were. So
you throw in India too.
That's right.
Yeah. Another billion people.
And
wanting to live
Brazil
better,
and the oil-producing countries themselves are an important source of demand, and so on. Now Brazil's going to be a net exporter, but and that's another country where there have been some important new discoveries. So maybe they'll bring another 1 million barrels a day online within the next few years, or whatever. But I think there's a new element in these calculations, which is the pace of the growth in demand from so much of the world. And a lot of our traditional supplies are going into decline. Certainly the U.S. Petroleum production has been declining for the last 40 years. and that's the oil that we are producing now. A much increased fraction of it is coming from offshore. But it's just a geologic fact of the decline in the U.S. Petroleum resource, and the North Sea is in decline now. Mexico is in decline. Indonesia was one of the original members of OPEC. Now they're an oil importer because of the declining production rates. So there is a real issue there. And although I don't want to say that's the situation every single location in the world. It's not. There are some promising spots. I mentioned Brazil, Africa certainly, maybe Saudi Arabia. Who knows what's going on there? But you need a lot of extra production to keep up with the natural decline rates and to keep up with the growth from the newly industrialized world.
What about the role of speculation? A lot of people blame sudden price increases. In this case, not so sudden, but it's sustained. But any kind of price increase gets blamed on speculators. And I want you to tie in your answer to that to an issue I think was raised first here on the program by Robert Barrow a couple years ago, when he noted that it wasn't just oil that was going up. It was almost every commodity was going up. And that although we could tell a supply and demand story about this market or that market, it's a little harder to tell that story. You can always say that, well, they're all positively correlated with income. As the countries get richer, they're going to demand more of everything, not just oil. But what do you think of the role of speculation in explaining the rise? And do you see any commonality across commodities besides oil?
Well, we started off talking about the decade-long trend, and that was a key thing I was addressing. And for those purposes, certainly above-ground inventories are not particularly relevant. I mean, you can add a little to inventory or take a little out, and that's not going to make any difference over 10 years, certainly. Now, it's a separate question when you get into the month-to-month fluctuations or the day-to-day fluctuations. I mean, there's no question on a daily basis, movements in the price of oil are entirely speculation in the sense of people making guesses about where the future is going to be, and those guesses might be right, they might be wrong, and to the extent they're wrong, it's going to show up in inventories. So I do think there is a role of speculation, and in particular, if you look at 2009, U.S. inventories, for example, of oil were consistently above their trend throughout this year. And so I think there is a case to be made that's one factor in what's going on. And I think it may well be a factor in the increased correlation of the daily price changes one with another. But I wouldn't want that fact to confound the longer run reality, which we were talking about a moment ago. And so it's certainly a mistake. It would be a mistake, in my opinion, if you were to say that all of that price increase from $50 a barrel up was just speculation. I don't think it could be. Now, as far as the increased correlation with other commodities, I think on the daily basis that could be part of it, that they're financial factors that are moving these together. But there are also some commonalities in that, as I said, China's not just buying oil; they're buying copper, they're buying
corn.
Increasing meat consumption, putting pressure on
grain prices.
Grain.
Yeah.
So there is a common aspect of that to all of these questions. Now, in the case of agricultural production, you'd think that we should be able to increase that. That's something that there is a margin to work along. Whereas, as I was mentioning in the case of oil, there are definite limitations to what you can do, at least in some of the traditional producing areas.
But my thought at the time, and I don't know if it would be borne out by a more careful look at the data, but my thought at the time was, besides China, we had a ethanol mandate in the United States that put pressure on corn. As more land went into corn, which it would try to do, and it would go into land that wasn't quite as good for corn as the land that was already in corn, that would make the price of corn higher, certainly in the short run, as land was pulled away from other soybeans and other products, that would raise their prices. So you could tell a story there. But of course, it's not just agricultural products, and it's not just oil. I think it's copper, and it's all kinds of things, which of course again are correlated with economic growth. But in the past, we've had immense amounts of economic growth. Last 50 years, they don't tend to get associated with long-term secular price increases. In fact, it goes the other way. Things tend to have gotten cheaper as technology's improved, and it could be this is just a short-run phenomenon, but it's an interesting time for that. I don't know.
Well, I think there is a change in terms of the character of the growth, so we went 4 years there from 2003 to 2007 with 5% real GDP growth globally. That's a pretty big deal, and I'm not sure what the historical precedent for that might be.
It's an interesting point. I hadn't thought about it. I wonder, it'd be an interesting number to look at. Let's close with the related question on oil prices. What evidence do we have? This will be something I think economic historians and macroeconomists will argue about for at least a decade or three. What evidence do we have of the role of oil prices in causing the current recession? So when oil prices were rising at the beginning of this decade-long period we've been talking about, people said, oh, this is going to destroy the economy. The economy kept humming along. We got to 2001. We had a recession. Most people attribute it to the tech boom collapsing. And it was very short. It didn't have a big impact on GDP or employment. It was small by historical standards. And we started humming along again, even though those oil prices continued to rise. So what do you think the connection is between oil price shocks, increases, whatever you want to call it, and the growth rate of the economy?
Well, for much of that earlier period that you're talking about, it's true that there were increases in oil prices, but they were coming kind of gradually. And so, you spend a few more cents each month on gas, but your income is rising at the same time. And I don't think people responded to that in any significant way. And partly that's related to the observation I was making that the expenditure share on energy had fallen dramatically from where it had been in 1980, so that it just wasn't as big a deal for consumers. But what you had happen beginning in the fall of 2007 and running through the summer of 2008 was a big, dramatic, and rather sudden move up, and
huge change in the price at the pump for gasoline.
And that was now that expenditure share became quite significant, and just in terms of the mechanics, people couldn't go on ignoring that price increase. They had to cut spending, and so, for example, what you saw in the summer of 2008 was maybe a 25% drop in purchases of the SUVs and light trucks. And that was at the same time that purchases of the more fuel-efficient imported cars was actually going up. So it seems to me there's a pretty strong case that what was happening to auto demand, for example, at that point, had a lot to do with that kind of sudden move in energy prices, and that was a pretty big deal for the U.S. Auto sector. And you can point to the lost jobs and the lost income in the auto sector during that period. I think there's no question that was at least partly traceable to what was happening to energy prices. Moreover, if you look at consumption spending generally, it was starting to be a real drain on consumer budgets, and the slowdown in overall consumption spending following the energy price increases was quite in line with the historical correlations between consumption spending and energy prices. So I think there's pretty good evidence that the energy price increases were one factor that was certainly hitting some sectors of the economy at the end of 2007, first half of 2008, in a way that was not helpful. Now, of course, at the same time, we had housing and its problems. housing was subtracting about 1% from annual real GDP growth during the first year of the recession, but it had been subtracting that a little bit more the year before the recession. So my own view is that the energy price increases were the straw that broke the camel's back. That once you had housing and autos and overall consumption spending, consumer sentiment all tanking together, that was what tipped the scales into a recession. Now, of course, then in the fall of '08, we had the financial crisis with the failure of Lehman and all the rest, and that put us into an entirely new phase where I wouldn't remotely suggest that what happened there was directly caused by oil prices, but I think we were definitely dealt a tougher hand in the fall of '08, given that we'd already gone through 3/4 of a recession. So my view is that energy prices were a contributing factor to this most recent recession, just as I believe they were a contributing factor to a number of previous historical recessions.
So now we can try to come full circle. I can ask you something I meant to ask you before. We're talking about the default issue. And that's the transmission mechanism between financial markets and the real side of the economy. There is a view that says the recession we're in is totally a result of financial issues. The other view, as you said, is a more complicated picture. And it's hard to argue the latter because it started in December of '07. At least that's the official measure. So it would have to have some real side part to it, it would seem to me. So the question I meant to ask you before that I didn't would be the consequences for our lives if there were a serious default outside of the inflation. As you said, we probably won't default, but if we end up inflating our way out of our debt problems in the United States, other than the fact that inflation is not a healthy thing for decision making, will there be any inherent real side implications for American life? And in turn, try to tie that in, good luck, it's a tough question, to this observation about Wall Street versus Main Street and the current mess.
Yeah, I think it would be very unfortunate for Main Street if we were to have these problems. And the nature of the difficulty is if you don't trust your money being lent to the U.S. federal government, how do you trust your money lent to the U.S. bank or the U.S. firm or the U.S. consumer? If the government's having trouble borrowing, you better believe the rest of us will in addition. And I think we saw pretty clearly in the fall of 2008 that when credit dries up, it sends the economy into a nosedive. And as we were saying, there are a variety of examples you can look at historically for what we're talking about, a default or currency crisis. But the kind of thing I'm talking about would be a joint problem with the currency and the overall banking financial system, which was a very unpleasant experience for the countries that went through it, and I think would be all the more so for us. On top of which, as I was saying, because the U.S. historically had been such a safe haven, and there's a lot of confusion in figuring out, well, what's going to replace that, I think there'd be a global aspect of the problem that it's really not something we want to see at all.
Well, let's close and get you to talk about causation and macroeconomics generally. You made a very brief statement a minute or two ago that you think the rise in the price of oil is a cause of other economic downturns historically, not just contributing to the current one. We've had Ed Leamer on the program, who has written a provocative and interesting paper about housing prices being a driver of recessions. Of course, many people believe that monetary policy is sufficient to explain most, if not all, of economic business cycles. Keynesians are going to look at, I'm not sure what Keynesians look at, loss to confidence, animal spirits. So we have all kinds of competing ideas in economics. What do you think the ability of data are to help us untangle those? And how much of it is just, well, I'll just leave it at that. What do you think the state of our knowledge is about what causes business cycles and if it's gotten better or worse over time?
Well, it's not what we'd like it to be, and I think one reason for that may be that an element of recessions, in my understanding, is missed expectations. So if you knew a recession was coming in 6 months, the Federal Reserve would have acted differently. Businesses would have acted differently with their inventories and hiring and investment and so on. And, sort of by definition, for things to go this wrong, something must have been other than what the majority of actors were counting on. And furthermore, when you go into the details of what was happening with different sectors and different parts of the economy and different recessions, they start to look quite different in terms of the some of the propagation. And that to me is consistent with this idea that it's really something a little bit different from the last one this time. On the other hand, there is some common element. There's some critical mass that once enough sectors are having problems at the same time, the system seems to go into reverse. So we can see it once it's happening clearly enough and say, okay, here we go again. We seem to be a long way from being able to say, okay, we're about to have one of these things 6 months from now. As I say, that latter failure may be inherent in the nature of the beast, and maybe we shouldn't be expecting to be able to predict recessions any more than we expect to be able to predict stock prices.
My guest today has been James Hamilton. James, thanks for being part of EconTalk.
Thank you, Russ.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.